G'day there, Wealth Press viewers, subscribers, traders, and investors. It's another midweek update, and today my guest is Adam Sarhan. Adam, welcome.
Thank you.
Adam, we were having a discussion earlier this week about modern monetary theory,
Yes.
and this idea that's now being supported academically that governments don't necessarily need to balance budgets, deficits are not necessarily evil, and revenue need not necessarily be derived from taxation in the case where modern governments are able to borrow from themselves.
Right.
And the entire tone of the discourse at the mainstream financial level seems to be quite focused on conveying the perception that that should be our expectation, that deficits and economic data no longer is a contributing factor to the performance of markets, and we should just get over that. How do you feel about that?
So I take the other side of the trade, if you will, meaning I don't agree with that logic. In the short term, absolutely works. There's no question. It props up asset prices. It puts what they call the Fed put below the market, which means every time the market gets in trouble, the Fed's going to step in with more easy money, and then it'll shoot the market right back up again. But in the long term, it just doesn't work. It's not even like a house of cards. It's worse. Think of a patient on a table in a hospital that's dying, you're going through some severe trauma physically, and then they inject them with a bunch of short-term steroids or whatever, just adrenaline to pump them up. And the patient's, kind of doozy, but it was able to overcome that fatal scenario that might have happened. In the short term, you can keep pumping the patient with those, stimulus, for lack of a better word. It'll work. But in the long term, what are you left with? Borderline a zombie type state, if anything, and meaning the economy. And it's not sustainable in the long term. And when we go back and study history, like we mentioned earlier in the week, you look at other major economies that have fallen from within, it's because of lousy fiscal and monetary policy.
Right. So, I mean, we're watching a sell-off occur in the Dow and the S&P. Tesla's lost 18%, Apple's plummeting. Is that sort of, that kind of volatility, is that sort of a side effect of this kind of approach to stimulus?
Yeah, it's no question. You're in one of the strongest bull markets in history. What we've seen since the March 2020 low up until now, September of 2020, has just been absolutely not unprecedented, but it ranks up in the top 1% of rallies in the history of the market. And when you go back and study those kind of exaggerated moves to the upside where they barely pull back, they barely correct, every single time it ends in tears, meaning back in 1929, you had a similar run. In the 1990s, 99 into March of 2000, you had similar runs. Doesn't mean this one's going to end today. No, you have violent pullbacks and they can continue to go up, but it's that game of musical. As long as the music is playing, meaning the markets are reacting well to all this easy money that's being injected into the system, higher prices in the stock market will fall. Dips along the way. Sometimes the music stops in the game of musical chairs. One guy's knocked out, the next girl comes in, whatever it is, right? But eventually the music stops, and the last person left standing gets wiped out, and there's one person that wins, and those are the people that have been able to get out early in the stock market's world. So for us now, as long as the stock market continues reacting well to all that easy money, then we have to expect these pullbacks, this volatility, to be part of the process, because markets don't go straight up. It's normal and healthy for markets to pull back. What we saw this week, which is a way overdue pullback from exaggerated and extremely high levels.
Okay, so then, in the spirit of the corrections we've observed in 2020 so far in the marketplace, I mean, I almost feel like, okay, 18% is enough for Tesla to lose in a single session, or rather in a single week. I now think Tesla's a buy, not based on fundamentals or even technical indicators, just based on a sort of pattern recognition, consistency, on the fact that the continuing flood of liquidity as a result of fractionally banked out quantitative easing has not gone away. And so obviously corrections are going to happen when guys say, okay, this has gone far enough, let's take some money off the table, because this is just free money, let's just take some off the table. And so selling begets selling, and next thing you know, you have a correction. But it's just a matter of time till they're going to say, well, great, we got the money off the table, we've locked in the profit, let's go back in there and take the market higher. I mean, that doesn't seem to be at any risk of ending anytime soon.
Yeah, well, two things. Number one, remember this week you had two historic stock splits, Tesla and Apple, for 2020. Out of all the big splits, those were the two biggest, most well-known. And ahead of those splits, buy the rumor, sell the news kind of a thing, where these two stocks, if you look at Tesla or Apple, I own both, full disclosure, and up triple digits in both, have been rallying 10 to 20, if not 25% per week over the last 4 to 6 weeks. That's not sustainable. So you get the split, which happened effectively on Monday of this week, on the 31st of August. And then all of a sudden you had to buy the rumor type thing before the split. And now you've got sell the news. After the split happened, people are just selling into it. We saw yesterday, Tesla's largest institutional shareholder, the position got too big over their mandate. So they had to sell some. They didn't sell because they lost faith in the company, to your point. They just sold because they had to adjust it based on their size of their portfolio. So yeah, to your point, these stocks, as long as these pullbacks are healthy, they could be scary in the short term, no question. But as long as they're healthy, then yes, they become viable opportunities.
Right. So, and we seem to be, seeing a solidification of the, I'm going to say the selective nature of the real bull market performers. I mean, it's not a rising tide lifting all boats by any stretch of the imagination. In fact, increasingly, it's a case of a very small percentage of the issuers are the exclusive beneficiaries of the irrational exuberance that has come to characterize the market. Where does that leave the rest of these companies that are not household names and therefore not the subject of rampant buying?
That's a really good point, James. If you go back and study history, you've seen this before, where it gets towards the end of a bull market, the latter stages, whatever you want to say. I mean, effectively, we've been rallying since 2009, right? We had a few brief pullbacks or corrections. If you want to call the bear market and the COVID one in March that lasted 3 weeks of bear market, okay, but it's not really a bear market in my world because you've never had a bear market that lasts 3 weeks, right? It's just a very steep correction.
Right.
So that being said, you're 11 years into this rally. Yes, you've had some pullbacks along the way, but you're now getting the latter stages of what we've seen before in these climax moves, where back in decades ago you had the Nifty 50, or you had in the 1920s you had the railroads, which were the new and the automakers with the new technology of the day. They revolutionized the way people commuted back and forth, and the automobile stocks back in the 20s were just every single day we're just going bonkers to the upside. In the 90s, you saw the dot-coms. Anything with a dot-com was just taking off with double, triple, no earnings, no revenue, but the stock didn't matter. The irrational exuberance, buyers would show up and buy because it just had a dot-com. So we've seen this several times over history. What it means for the rest of the market now, a lot of that depends on what ultimately ends up happening. If we get that narrowing of leadership, which is mainly those stay-at-home and big tech stocks that we've seen that benefit from this new COVID world, if that just happens to be the new normal, where everyone's walking around with masks for the next decade or longer, or everyone's not traveling or scared to do this and scared to do that, so on and so forth, then those stocks will obviously continue to benefit. The other stocks will not. I don't think that's going to happen. Therefore, if that doesn't happen and we start getting back to our normal idea of life, meaning walking around and traveling and doing things, the rest of the market, which is so undervalued now and has gotten beaten down so far, will bounce extremely high. And think of that rubber band analogy, right? Where you're pulling these tech stocks and the stay-at-home stocks so far, and they're so exaggerated now, the gains to the upside. On the other side of that are the rest of the market, the non-stay-at-home stocks, if you will. They're so depressed and the valuations have come down so much. So once we get some clarity with respect to what's going to happen post this awkward COVID stage we're in and what life is going to get back to, then you'll see that the downside or the bottom of the market, if you will, the laggards, rally with a vengeance, because money's going to rotate out of those leaders and into the laggards, because that'll be we'll get back to normal.
Sure. So we saw that Novavax reported early stage trial results that were testing for the safety of its vaccine, and with the secondary scrutiny of its efficacy in terms of generating an immune system response, and both were favorable in that nobody died, nobody got sick, and there was an immune system response. Novavax traded up very slightly on that news, but for the most part, the sell-off continues in the coronavirus stocks. And I found that curious because I thought, well, on such great news that, you know, they've proven the safety and demonstrated some efficacy, I thought the stock would just take off and it would be, you know, more of a collective hurrah that this American company has now come out with a vaccine that is demonstrating effectiveness through the proper processes.
Right.
And that's the key. Because it's early stage, we're not going to see any stage 3 clinical double-blind trials necessarily for a vaccine any faster than we're seeing them now, because that's the process that a proper vaccine scrutiny has to go through. Unlike what we're seeing out of Russia and China, you know, where it's just like, hey, we're going straight to stage 3, and I'm going to give it to my daughter. That's how confident I am.
Right.
But so I guess that's the key to what we should be watching here, really, in terms of a fundamental trigger, is if a vaccine emerges that is clearly safe and clearly effective, then we should start to look at a broader economic recovery. And if we don't see a safe, effective vaccine emerge, the opposite becomes the truth, and we are going to be around in masks and not taking cruises and not flying at airports. So that's really kind of like a single indicator out there in the wind that's nice and visible, easy to follow, and is very, very likely going to have the exact effect that I just described. Would you agree with that?
Yeah, I think it's a really good point. The other side of it, I'd like to put things in perspective as well. Back in March, that stock, NVAX is a ticker, was trading at $6. A few weeks ago, it almost hit 200. I think it went up to like 190 or 189 or somewhere in that range.
Yep.
So now it's pulling back. I can quickly check. It's $107 from where it was in March, and all these COVID stocks are still in the same situation. They've gone up so much that, yes, they are under some pressure, some selling pressure in the last few weeks, but that's normal after a huge move. I mean, from 6 to 200 or, you know, to 190, that's a massive rally. And that's not just that. Look at Moderna, look at a lot of other biotech, you know, COVID related stocks have had massive moves. So from my standpoint, I always like to step back and look at the bigger picture, you know, 5 years, 10 years, 3 years, a year even. This happened within what, 6 months now? We're 6 months from March, 9 minutes, 6, right? So we're 6 months away. These stocks have had massive moves. They've earned the right to pull back and digest some of those moves. And I still give them the bullish benefit of the doubt. So a lot of what we're seeing is that buy the rumor and sell the news kind of thing, where, yes, I think the market had forecasted back in March, April, May, June, and July that, yes, we're going to get some kind of a vaccine. We're going to get out of this. This is not going to last forever. It's not going to cripple society as we know it. And the stocks were bid up much. I mean, they've had massive moves. So now that we're pulling back a little bit on the news, I think it's okay. It's normal. It's been priced into the market. Now, if we start falling on the news, that's what would really get me concerned. Because if these stocks go, let's say it's at 107 now, NVAX, and it goes down to, let's say, $50, and they have a positive outcome, that would be something disconcerting. But if it's just, hey, we've gone up from 6 to 189, we're now at 107, and it pauses for a few weeks or months, I'm not too worried about that. But if we start seeing some massive selling, that's where I get more concerned.
You bet.
That make sense?
You bet. Okay, so Adam, what is it that you are looking at right now that you really like and that you're comfortable holding or adding your position to?
Sure. So look at these tech stocks that are getting mauled today and the next few days. I expect this to continue. And what I want to see is how these stocks, how the NASDAQ 100 and a few other indices as well react to just normal areas of support. And for those of you that aren't familiar, support is like a floor, resistance is like a ceiling. So let's say you have a stock trade between 10 and 12, 10 would be support, it goes to 12 would be resistance and back down to 10, so on and so forth. So one popular easy way to know support in a bull market is just to look at the 50-day moving average. People follow it. It's just a common tool that everybody uses. It's available in any stock charting service for free. So what I want to see is where the major indices, the Dow, the S&P, the NASDAQ, specifically the NASDAQ 100, what they do with respect to their 50s, and the Apples and the Teslas of the world and the Pelotons and the other work from home stocks that have Zoom, all these stocks have just benefited and have massive life-changing wealth in the last 6 months, how do they perform with respect to their 50-day moving averages? If it's a normal, healthy pullback, they bounce in the 50 and they rally off of there, great. That'd be a healthy buying opportunity. Now, if they slice through it like a hot knife through butter, different story. So for now, we're so extended. I mean, they're just pulling back to the 10-day moving average. So you still have got the 21-day, you have the 50. So I just give it a lot more time. There's two things I look for, James, in everything in the market. There's price and then there's time. So time's an important element that most people just don't even think about. But stocks need time to consolidate moves. So it either goes down to consolidate it or it goes sideways. And if we just sit for a while, that'd be very, very, very bullish. If we pull back for a little bit but find support, that'd be very bullish as well.
Okay, great, Adam. Well, there's lots of great points you make there. We're going to leave it there for now. I really appreciate your contribution today, and I look forward to speaking to you hopefully at the roundtable again next week. Have a fantastic weekend.
Thanks, James. You too.
Thanks. Bye-bye.
Bye-bye.